few housekeeping notes to start. We want to be respectful of everyone's time, so we are going to mute all the attendees while we're doing the presentation. Like I mentioned earlier, we will have time at the end for open discussion. And if you have any questions during our presentation, you can put them in the chat box and we'll get to those at the end as well. We do ask that you please review and read closely all the disclosures that are outlined here for compliance. All right, let's begin. 2021 investment outlook. We need to click.
There we go. So Dwight D. Eisenhower said this about war, and we believe it's true for projections as well. They're important to make in order to frame the way we think about the world and the way we manage investment portfolios. We just can't expect all of them to come true. So we've been getting a lot of questions on these topics and wanted to take time today to lay out our base thoughts on each of them. Of course, we'll cover things like the change in the White House, what bubbles might be forming in the market, low interest rates and income, and of course, Bitcoin. So it's important to note before we start that the stock market is a $40 trillion pool that has a lot of participants, and not everybody wants the same thing. Day traders don't invest for the same reasons that hedge funds do, and pensions and governments don't invest the same way a recent retiree does. So with all of these players in the pool, just two things. One, make sure that you understand that stock prices are fairly efficient because they reflect all of the attitudes and expectations. And secondly, your neighbor's investment goal might not be the same as yours.
Can you admit him?
Of course. NPR ran an interesting survey in 2015. They asked over 17,000 people to guess how much this cow weighed. And of all the people surveyed, they got within about 5% of the cow's weight. Some people were far lower and some people were far higher, but we think that this applies to investment markets as well. As we mentioned before, there's a lot of people guessing. And so generally the wisdom of the crowd tends to be a little bit more right than not. Notably, self-described cow experts, not sure who those people are, were off by a greater margin than the general public. So we've seen a lot of cow experts on TV in 2020. It was a stark reminder as to why we don't pay attention to every billionaire that goes on CNBC. If you listen to any of these people in March or April, you missed out on roughly 60% in growth stocks and even recovery in things like real estate and bonds. So there is a big industry for selling fear, but just say don't take it too seriously. So here's the challenges investors have today. Stocks are sitting at all-time highs with a forward PE of roughly 25 to 1. That means for every dollar of earnings the S&P attains, you're paying roughly $25. The average is about 16. International stocks are trading at slightly above average rates as well. The Fed forecasted it'll keep interest rates at 0 through 2023, and so that means that bond yields are going to be historically low as well. Real estate comes with added volatility and lower than average yields at 4 to 6%. We all know that the pandemic-driven stimulus is going to mean higher taxes. This is a picture of America's longest running senior care facility. It's also the White House. And there was a lot of change this year, and we've been getting several questions on what the policies mean. First, we'll reflect on the tenure of Donald Trump, who had a pretty decent Dow return over his 4 years, and he would have you believe that it was the best of any president of all time. Data shows actually it was fairly average. Stocks usually do around 10% per year. That's their long-term average. They did 12 the last 4 years. Prior to that, they also did 12. And so I think it's important to put in context that the market doesn't vote blue or red. The market just likes money and capitalism. This is an interesting reminder from Prudential. They looked at presidential approval ratings over the past 100 years. They found that stock returns were actually higher under presidents that had lower approval ratings. And so for some of you, that's a good thing for these next 4 years. The biggest question we're getting is, what are higher taxes going to do to stocks? And it is very rational to think that higher taxes will hurt earnings, and they usually do. Fidelity put out this interesting chart that showed over the last 50 to 70 years, every time there was a higher tax on either capital gains, corporate, or personal taxes, the market on average did better than it normally does. The average return is about 15%. So why is that? Well, generally higher taxes are accompanied by a higher stimulus, and the market likes free money as much as anyone. 2020 was an important reminder of a lot of things. One of those is that we shouldn't try and time market events. Since the election, small caps are up roughly 30%, large cap stocks are up roughly 10 to 12. And it's not always about who's sitting in the chair in the White House. There's also other things at play, such as the economic recovery, the vaccine, low interest rates, and a general improvement of the economy. Finally, we look at how much stimulus has come in versus how much will be coming. In March alone, the stimulus bill of 2.5 trillion was already larger than all of those combined through the Great Recession. We have another 1.8 trillion on the way too. So if stimulus has been helping stocks in the recent year, we think it'll continue to improve stocks through 2021, albeit in different sections.
All right, well, the stimulus seems to be working, as consumers did surprisingly well in 2020 with a rise in personal income and a decline in spending. Credit card debt is down and personal savings is up. According to the Federal Reserve, consumers are sitting on over $1 trillion of cash in their bank accounts. There's a lot of pent-up demand out there. One of those demands is leisure, and leisure is coming back, at least early data confirms. There is a real desire to travel, some even wanting to just experience the excitement of a plane ride with no destination in mind. I read about the flight to nowhere. I don't know if you heard about it, but Qantas Airlines offered a round trip 7-hour flight from Sydney, Australia to Sydney, Australia with 0 stops on October 10th, 2020, and the flight sold out in 10 minutes. Looking at what did well and what did not do well during COVID, we saw major sectors of the economy move in sharply different directions, reflecting the disparity between those that benefited and those that got crushed by the pandemic. The obvious sectors that were crushed, travel, hospitality, retail, and energy, most of these companies are known value companies or value stocks. The stay-at-home, work-from-home sector saw a boom. Tech, healthcare, home improvement stores, and of course, toilet paper. Most of those areas are growth, with the exception of the toilet paper. The post-pandemic economy will look very different. It will become more efficient and dynamic with clear winners and losers. On this slide, we're looking at growth versus value. Growth has outperformed value in the last decade, but will it last? If you look at the chart, you can see that growth has outperformed value 6 times since 1945, but each time after, value has had a significant recovery. One perspective on returns when we talk about growth versus value, it's important to note that the total return of value stocks include both the capital gain and stock price, as well as dividends, whereas growth stock investors typically rely on just the capital gain or price appreciation. When we think about value companies, which we've gotten the question a lot this year on why Why are we owning value companies? Although they may be out of favor in 2020, if you look at the chart on the left, since 1970, 78% of the total return of the S&P 500 was made up through dividends and reinvesting. If you look at the chart on the right, it shows the impact of dividends on total return by decade. And without going into too much detail by decade, the decades that had the strongest growth, 50s, 80s, 90s, and 2010, how do you say that decade?
The odds.
The odds. Dividends had contributed less to the total return. Interest rates, as we know, are at all-time lows, 0. And US bond returns tend to follow interest rates, which would mean bonds aren't going to be bringing a lot to the table in regards to income anytime soon. But we don't want to abandon bonds or fixed income. Total returns are going to be more modest, but bonds play a vital role in portfolios. There's 4 critical roles. One is to diversify against equity. One is income, albeit will be smaller than normal with low interest rates. Capital preservation and inflation protection. I think this is a great reminder here, as investing in bonds when the market is up 30% can be boring. But when you look at just the beginning of last year through the end of last year, you see this S&P fell more than 30% at the start of the pandemic, while the Barclays Ag, which is the bond index, fell just a few percentage points at the height of the outbreak and recovered much more quickly than the stock market. There you go.
So low interest rates have had an interesting impact on a number of sectors, but one thing that I think we could have all not predicted was that money losing companies from 2019 would actually have phenomenal gains. The biggest returning stocks of 2020 tended to be those companies that were money losers. Chart here shows that there's an average of 416 companies that were $1 billion or bigger that had net loss, and the average return was 57%. Most of them had substantial gains, and some of them were up even 200% or more. I think that this clip from the satire show, Silicon Valley, does a good job of explaining maybe some of the environment out there.
Richard, one potential issue, our hosting fees can become a challenge as we scale.
We can offset a lot of that once we get a few customers and start
Oh, the volume's on that side.
What? No revenue. I'll call you back.
Can you guys hear it?
Why would you go after revenue?
Can people hear this or not? A little bit.
Oh, you know.
What are we doing? All right.
Revenue.
See if that works.
Potential issue, our hosting fees could become a challenge as we scale.
We can
Chat.
offset a lot of that once we get a few customers and start a subscription revenue model.
What? Revenue? No revenue. I'll call you back. What? Why would you go after revenue?
Because to make money?
No. If you show revenue, people will ask how much, and it will never be enough. The company that was the 100X or the 1000X becomes the 2X dog. But if you have no revenue, you can say you're pre-revenue. You're a potential pure play. It's not about how much you earn. It's about what you're worth. And who's worth the most? Companies that lose money. Pinterest, Snapchat, no revenue. Amazon has lost money every quarter for the last 20 years, and that Bezos is the king. Okay. There's no revenue. No one wants to see revenue. Go.
I just thought that mainly the goal of companies is to make money.
Yeah, no. That's not how it works. I don't want to make a little bit of money every day. I want to make a ton of money all at once. ROI. ROI. You know what that stands for?
Return on
Richard.
Oh. So I think what we're experiencing with a lot of these money losing companies going through the roof, or pre-revenue, as they might be called, is that people are starting to get some fear of missing out. And Warren Buffett talked about this and how bubbles are formed. He's basically said that people know that their neighbor's getting rich, making a bunch of money, and they get bored with their long-term portfolios, and their spouse is on them saying, hey, why don't you get a piece of that too? And all of a sudden the stock that's up 100% goes up 2 and 3, and then it pops. This definitely happened during 1999 in the tech crisis. We saw Sun Microsystems, for example, run up from $2 to 150, and then within a year it was down to $2 again. Markets are definitely prone to bubbles because the people participating in markets are not emotionless like the market itself. We have emotions, and greed is one of those. Interesting reminder of how bubbles start. Generally, you get the smart money, which would be the early investors or the venture capitalists, and then you move into the hedge funds and mutual fund managers. And then once it starts hitting CNBC, you know it's on. It starts to go up. People start talking about it over Thanksgiving break. The nephew's telling grandpa why he needs to own some Bitcoin. And then once everybody's convinced that this is the new paradigm and this is going to be the future of everything, it starts to dip. You see some denial. There's one last little trap, and then the floor goes out. The only thing that this chart will not tell you is where any of these assets are when they're going here. But we do know that the emotions are always going to be that whatever this thing is inevitably the future, and that not owning it is going to be the greatest mistake of your life. That's when you know you're here. Speaking of bubbles, lower interest rates have done an interesting thing to markets, but one thing I don't know that we could have predicted was baseball cards selling for millions of dollars, or Pokemon sets from the 90s. You're seeing groups like Fundrise, which is a company that helps you invest in various things, or Masterworks will help you buy art. And essentially you put a couple $1,000 in, they'll buy a piece of art, and then they flip it to somebody dumber for a crazy amount of money. And even classic cars now are going for millions upon millions of dollars. The big differential or differentiator between what these are and what traditional assets are is these are collectibles. They have no cash flow at all. Holding them will yield you nothing. The only way you make money is if you flip it to somebody else for a higher price. So it's important to remember the difference between assets and collectibles. Speaking of collectibles and assets, Bitcoin is once again on fire. For those of you who don't know, it is the first and largest asset and growing category of what's called cryptocurrencies. These are essentially currencies that are not manipulated by federal governments. Nobody has control over them, and they have no intrinsic value, which makes them the perfect speculative asset. They're not held down by things like earnings or dividends. What has caused the run up? Well, essentially, there's no good way to bet against the price going up. If you were to go out and buy a stock, somebody else could take the other side of that trade and bet against you with a short sale, or they could buy options against you. However, with Bitcoin, it's almost impossible. So as you get a swelling interest of buyers, the price naturally begins to gap up. So where is it going? Well, a lot of new voices have given it a short run target of 50 to 60,000 and a long run of 420,000. A lot of these financials, which were once decrying it as a fraud, are now getting on board for whatever reason. And FOMO, yep. And they're declaring it digital gold. As more and more companies adopt the ability to hold it and transfer it, it actually kind of puts a price floor under it. So because of that, we think that it probably has room for upward movement. However, it's keep in mind, this thing crashes regularly. It's part of its cycle. As far as adding it to your portfolio, I don't recommend doing it that way. There's been a couple companies that have come to market, the Grayscale Bitcoin Trust and the Bitwise 10 Index Fund. Both of these trade at substantial premium to the assets. Imagine buying a $10 bill for $20, and that's what these funds are today. So if you're a true anarchist and you believe that the future of money is digital, you should probably do that on your own in a Gemini or Coinbase account. Don't try and do it with your IRA.
Okay. A lot of information. Takeaways for the next 5 years. We expect higher than average stock market volatility, maybe returning to a more normal cycle where we see 10% pullbacks annually, at least once a year, and 15 to 20% pullbacks in growth sectors. Below the historical average 10% returns from broad stock market indexes, we don't think we're going to continue with the average 10%. However, value and healthcare should outperform. Higher returns from international stocks after lagging for a decade. Many of us have wondered why we owned international over the last several years. The long, safer bonds are going to provide roughly 0% return. And several collectibles posing as alternative assets. Bust and join Beanie Babies in the WOW, That Was Dumb Investment Club.
Yes, there's always room for more in that club.
For most of you, when we're talking about portfolios, income's very important. And looking as we search for income, similar to what happened after the Great Recession, when interest rates were at 0.25%, we may have to go a little further down the risk spectrum to get the income that we need or want. You can balance the trade-offs between yield and risk. This chart is showing the pink are traditional income producers. The yellow are non-traditional. Traditionally, you get treasury bonds, not going to probably provide us with much income, if any, other than protection. Dividend equities is where we feel we're going to have get the most consistent income and growth. We also like preferred stocks. MLPs, given their great income, as you can see, their average drawdown is 27%. So we have gotten out of that sector several years ago.
Mm-hmm. Yeah, I think what we're seeing is that bonds used to be risk-free return, and now they're return-free risk. With interest rates at 0 and creeping upwards along with inflation, you're almost assured to lose purchasing power if you sit over here on the spectrum. So like Renee said, we like preferred stock. We've been allocating that to portfolios, and I think you get a double bump with equities from here. Not only do you get the value returning to favor, you also are getting in some of these companies 3 to 4% per year. Vanguard put out their 2021 capital outlook, and they tend to agree with a lot of what we are expecting. International stocks should do well, not only from depreciation or devaluing of the dollar, but also they have recovering economies and they're trading at a lower price than a lot of US stocks today. And you're also seeing value stocks should be overweight. Growth stocks, when you start at some of the values these companies are at, they could be incredible companies and they could be the future of the world. But keep in mind, everything everybody said about the internet in 1999 did come true. It just took 20 years for the earnings to catch up. And so when we sit and look at a lot of these companies trading at 40, 50, 60 times earnings, eventually they're going to have to grow into those shoes if we want to see further returns. Finally, we're staying away from real estate because we think that the work from home shift will be in some companies permanent, and it's like you saw on the last slide, a lot of downside risk for a pretty marginal income rate.